You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Danielle Park, editor of the popular blog Juggling Dynamite and president of Venable Park Investment Council Incorporated. Welcome back to the show.
Hey, Jim. How are you?
Well, I'm doing great. How was your holiday?
Good. Always work a bit through my holiday, but it had beautiful weather and was outside a bit, and that's always appreciated.
You suggest in your blog that demographics do not support the high prices we're paying for our homes.
No, I mean, there's many trends that don't support it. One is the fact that interest rates have been going down since 1982, and that now we're at, 2.3% or something for a 5-year term. One of these days, rates can only go in one direction, and that's up. And people will find that they currently owe 3 times as much as they can afford if rates are even modestly higher, or anywhere near where they were in even 2000 rates. Mortgage rates were sort of in line with historical averages. 5-year terms sort of around 6, 7, 8% was the historical norm. Well, if rates even went back to half of that today, most people that are heavily levered would have a very difficult time holding on to their house. And then, of course, you get a bunch of people needing to downsize then all at once or try and, sell their property to pay off some of their debt. At the exact same time that you've got the baby boomers who are all sort of planning to downsize, even if they're not heavily indebted, they're looking at operating costs for larger properties, which have gone up a lot in the past decade, and sort of saying, who needs all this property, why don't we sell? At the same time, the new homes that are being built, and that's what that article was illuminating, is that the new home starts going on right now in Canada. We're building 2 new homes for every working age person in the population. And that's actually higher than the 1.5 times we were building back in 1989, Jim. I don't know if you remember, in 89 prices peaked and then crashed an average of 25% nationally. They also had a big downturn in 1990 when supply also overwhelmed demand at that point. But the point is we're much farther beyond that now, 2 times instead of 1.5 times in terms of overbuild in the population. And also, not only that, but the size of home which has been built, has escalated so much. So it's all about, the sustainability of current prices. And unless you can force rates lower, unless you can find a whole influx of new buyers, the demographics back in 1980 and 90 were much more supportive of demand in the housing market and people moving up the property ladder, so to speak. Today you've got the exact opposite. The weight of people that have any funds or ability to own housing is at the top of the scale wanting to move down the property ladder. And so you've got this excess supply far and wide at most levels.
Why do you think this has happened?
Oh, well, we know it's been this falling rate trend since 1980, which means that affordability has increased every year. Just that, even with stagnant wages, people could afford more house because because rates dropped so much. You also had sort of a lot of erroneous policies, politicians wanting to keep smoothing the business cycle, keep escalating demand, not allowing any contraction in consumer spending, and so they kept trying to find creative ways to entice people into the property market, into all forms of credit, but very focused on cars and housing since they're the big ticket items. And so this obsession with, forcing the consumption by lowering rates, enticing interest in through various programs, government-funded, government-backed, political agendas were literally set both in the States and Canada to make it so that the housing percentage of the population that were homeowners had traditionally hovered around 65% in that range, and it was made a political point of trying to increase that. And in Canada, it moved up towards 70%. In the United States, it was a little bit less than that. But what we've learned that there is a certain amount of the populace that historically has sort of been able to manage housing, and once you try and reach beyond that, especially in a stagnant wage environment like we've had for the last 30 years, you find that you have less and less, healthy prospects who can actually afford to maintain all the costs that go with a property, not just the mortgage rate, interest portion, but all of the costs. So anyway, a lot of those policies, and the Canada Mortgage and Housing Corp, the decision to float more and more capital through that, could underwrite more and more mortgages, high ratio, high risk, taking more of that onto the balance sheet of the taxpayer. All of that were very disastrous trends to lever people up. And also the banks, the consolidation that went on in the banks. You used to have distinct lending from certain certain banks in the economy that were the main lenders, and then you had certain high ratio lenders. They were sort of a totally different pool of brokers, so to speak, for certain clients. But what you had was this amalgamation in the banking sector in the 80s and through the 90s, where, like in the United States, like all over the world, the deposit-taking institutions, which had typically brought in money on GICs and lent it out in mortgages, began doing all sorts of security trading, began buying insurance, buying brokers, buying investment counselors, buying everything, so that they were this multi-product offering. And the consolidation meant that you got huge financial institutions with executives at the top that were taking huge bonus packages based on perpetual growth targets that they were expected to hit. And so that meant just pushing, more out the risk curve, more cross-selling, more incenting those that really shouldn't be doing things to do them with risk, with credit. All those factors, really just made this perfect soup. And, we're 15 years into this secular period here where the Canadian stock market is again back where it was at the last cycle peak. Canadian consumer debt is at an all-time high. The Canadian dollar has broken down recently, Jim, this week, below where it was in the 2009 recession. So we think it's very likely it could head back towards the high 60s range versus the U.S. dollar again. So this is the end of a secular trend. There was this secular boom in credit in the world. It fed into a secular consumption frenzy. It fed into a secular boom in commodities, but all that really came to a peak in 2011. The QE mania from starting in 10, kept propelling prices and appetites for taking on more risk a little longer, but everything really peaked in 11. So that decade of 2001 to 11 was the secular boom in credit and consumption that is now mean reverting. And so we should expect a lot of things to begin moving back down towards their long-term trend. So that means housing, that means growth rates, that means currency in Canada, that means, we're in a technical recession already. The stock market's still trying to pretend that's not the case, but earnings are falling day after day. Investment spending is collapsing in the country. 40% downturn just in the oil and gas sector in terms of business investment in 2015. So you saw the Bank of Canada capitulate this week and finally say, we were wrong again to be hopeful about a quick rebound in oil prices. We were wrong to expect that we'd have a quick rebound in the second half. None of that seems to be the case. So they cut rates. Now, here's the problem, Jim. As you know, they were at much higher rates heading into the last two downturns. In these consumption downturns, which were cyclical in the last two. Now we're at 0.5% as an overnight rate. Yes, that's twice what the U.S. is at 0.25, but it still has very little meat on that bone in order to entice animal spirits. And so we're in the kind of big give back period. I call it the payback period after the boom. It's a reconsolidation. It's a bankruptcy of weak players. It's downsizing and right-sizing that has to go on in all levels, really, of our economy.
We'll have more with Danielle Park right after this.
More and more people are looking to the Internet for intelligent, riveting, and thought-provoking interviews. To advertise on the Goddard Report and TalkDigitalNetwork.com, call 604-699-8600, 604-699-8600.
Welcome back. We're speaking with Danielle Park. Danielle, if we're going into a period of downsizing and so on, is that going to mean more massive unemployment to face us when so many people have already started to work two jobs to make up for the job they lost last time?
Mm-hmm. Well, yes, unfortunately, what it means is that we're definitely seeing layoffs in Canada. every recession essentially brings a downsize in the employment numbers, and we shouldn't expect that to be different this time. We've already seen some of that year to date. I think there's been a lot of companies that have been able to sort of put off that day of reckoning to some extent because the interest rate environment has been so low, because the investment banking sector has been so reckless this cycle that they, people desperate for yield have been desperately buying high-risk product at ridiculous prices, so they're getting next to no yield. But the flip side of that is corporations have been able to borrow, incredible amounts of money, just like households, at very low rates. And so that, in a way, has allowed them to keep up the game a little longer than they should have. As you know, the economy and oil prices in Canada all peaked last fall, and around October, everything's been coming down since. The stock market is now negative over the last 12 months. As I say, the Canadian dollar has come down significantly. We're down 27% or so from where it peaked at 105 in 2011. So all those trends are coming down, and the reason we haven't seen more layoffs, quite honestly, is because of people in denial and corporations able to access more capital by floating more junk bonds into a desperately clamoring populace of people looking for income somehow. So in a way, that's really exasperated it. It's made them, hold off a little longer in some of their downsizing and some of their layoffs. They've said, hey, wait, they're expecting a rebound in the price of oil and commodities like they saw in the 2009 bottom. How it was that very quick V-shaped recovery. That was really, the catalyst there was a belief that China was going to save the day, that they were going to be able to spend us back into a big boom cycle, that their demand would be insatiable, that they had all these reserves they were going to be redeploying. And we did see them float the biggest, fiscal stimulus package in the world relative terms in the 2008-9 recession. So they had this, big burst of spending both in their own country, and that played out into a big burst of spending on commodities again, which was what buoyed Canada, New Zealand, Australia. A lot of these commodity-centric economies veered quickly out of the last recession and seemed to have come out unscathed. But now we see that there's this massive overhang that's left because China's demand has not bounced back, so they've spent the piggy bank in the short term, hoping that by now the world economy would have rebounded and be taking the torch, so to speak. That's not happening. We're seeing that demand in Asia is floundering, despite the official 7% reports of GDP growth, which is now flatlined in the official reports. Everything we're seeing is for a much weaker demand cycle going on and continuing in China. So all of that means that there's no probability, or very low probability, of a V-shaped recovery in these asset prices. So this sort of extend and pretend strategy, which has been so common in many corporations in the past, 9 months, hoping that this was just a quick blip, are now realizing that things are not bouncing back, that, Europe is a complete mess, that China's in a big downturn, and Canada's now, the Bank of Canada beginning to capitulate, currency traders starting to dump the loonie with fresh vigor because they see that all this is sort of heading in the wrong direction for commodity producers, resource exporters, that sort of thing. So, we missed a big opportunity in a lot of ways because we had this sort of once-in-a-generation massive boom in commodities and the things Canada was selling. But because we sort of wasted a lot of that money and time, sitting back on our laurels and picking up the easy money, so to speak, we really didn't diversify our economy. We really didn't think ahead and say, wow, in the new secular period, what if fossil fuels come under, are no longer in high demand because of efficiencies and because of alternative energies and because of a, undersaved population who's trying to figure out ways to spend less and save more. All of those factors weighing heavily against consumption trends in the world of the things that we produce in Canada. So we're now in the crunch phase. Now, necessity is the mother of invention. I'm sure we're going to figure out a way to reinvent ourselves, or we won't, and we won't do very well. But I think we will. We'll figure this out. I think that there's a huge boom coming. Not right now. We have to get through this current recession period and the downsizing and consolidation, but the next great big boom, I believe, is going to be in the alternative energy space. And I think that that's going to bring incredible opportunity. The advancement there is leaping and bounding. Now, part of that's because of the internet sharing of information. Part of it's because of the intense amount of capital that's been floating around, courtesy of the credit bubble the past few years. But the other thing is, it's just an ideas whose time have come, right? There's every reason in the world to figure out smarter ways to use energy. And I think that once people stop fighting that as the enemy and see that as the answer to the new economy, we're going to have a massive reinvestment boom in the world, and that's going to fuel the next big consumption potential again. You know, we always know that at the end of these secular bear periods, you get a secular bull that follows. It's just that we're not through the secular bear just yet. We have a lot more deleveraging to go, a lot more building up of savings, and letting some of these overvalued prices come down. That's also part of the solution, right? Is figuring out if you can't have buyers at current levels, if people don't see value in things like real estate, stocks, and bonds because they're so insanely overvalued, how, you know, at what level do they become attractive again? And there is a point in which they do, but the price point will yet to be discovered by the market forces and by having things sell off to a point where you see capital enticed back in.
Danielle, one of the things that has you optimistic is the development of a brand new car that is energy positive, one that actually makes more energy than it uses. Maybe explain that.
Well, this is the new concept. People have to get their mind around this fact that we have the capacity. And I put that article on because that's just a bunch of kids at a university who developed a prototype car that will go 600 miles on its own on a charge, and is sustainable, uses sustainable energy as its power. And basically, we're all of the old school mindset, right? The dinosaur mindset of you plug in an appliance to recharge it, and then we consume that energy while we're using it. In the positive energy mindset, you actually can produce more energy than you use. So, for example, a simple example is gym equipment. Currently, most gym equipment today plugs into a grid where you buy power to fuel it. In a positive energy scenario, your momentum and exertion on the machine itself can power the machine, and in some cases produce more power than the machine uses, in which case you're into a positive energy scenario where you're not only are you not buying the power to drive the machine, but you're producing enough to sell back to the grid. So this kind of technology is really, it's quite available and developing in areas all over the world today. So that's very exciting. So think of it. Energy right now is the biggest tax in the entire world on everything that humanity goes to do. They have been paying for these very expensive, very cumbersome, very polluting, very environmentally destructive energy sources, and it's been a tax on all of us at every level. In this new environment, we're going to figure out all these, well, we already are, it's not, we already have figured out many technologies that are, as we say, positive energy, create the exertion itself or the energy itself is sustainable and produces more than it takes.
Well, we have that right here in Vancouver. We have the young woman who invented a flashlight that runs off the heat of your hand. Scientists at Simon Fraser University in Burnaby have invented a knee brace that generates power when you walk. So if you have batteries on you, it can recharge them. And when you're going downhill, it can actually help slow you down and generate energy into your batteries as well.
Absolutely. Absolutely. So all of this is already here. It's not, people say, I'll believe it when I see it. It's already here. And it's eating the lunch of people who are not aware of what's going on.
Are the big oil companies buying up these inventions so they're not used?
I think they have been doing that in the past few years, like many years, for decades. They've been sort of looking after their own core business, pretending to be a, quote, energy company when in fact they're specifically a fossil fuel company, and sort of just pretending and platituding, buying up anything that looks like it might be up and coming or alternative. But I think we're way past that now, because the world, again, thanks to the internet, thanks to the ability to exchange information and ideas globally, freely across the planet, I think we're way past any one industry sector or companies being able to buy up and quash. It's just taking the middleman out. It's interesting that conservatives and business people often, will talk about, free market forces and, don't have taxes. They hate government taxes and all that. Well, this is just about removing middlemen and taxes that are not necessary for the function of the economy and letting consumers have a direct line to their own sustainability. And once you get that, you have consumers that are literally empowered and able to empower the grid around them. And so you're into a whole new dynamic. It's a very exciting thing. So first we have to get through this current recession where we have consolidation of weak players and actors, antiquated business models and managers. Those are going to be going through a squeezing process to sort of take fat out of the system. We're going to have write-downs of bad debts. That farce in Greece right now, the vote last night didn't fix a thing. Greece has to exit the euro or go to some new currency standard, independent of the euro or pegged to the euro in some way, but something that allows them to depreciate their own currency, get back to their own sustainable economic model, not where you're weakened by affiliation and free handouts from other people, which end up, being toxic for the viability of your economy. We have to have write-offs of all those bad debts, reconsolidation. It's very much about getting systems and companies and people to stop leaning on governments and expectation of external forces like monetary policy. It's about getting people back, standing upright, using their own, momentum, paying less than they make, building up their own savings. So it's a whole shift away from the past few decades where people have become more and more dependent on government and this idea that there'll be, money there for all of us and we don't have to save for ourselves and all that. That's no longer a viable idea. Hasn't been for at least 20 years, but it's become painfully obvious that that's not the case. So, and I think that the next, big asset contraction, which has already started in many markets, many of the preferred shares that I was speaking about, perpetual preferreds as an example that people were buying for income, are getting crushed, dropping in value. That's typical of this stage. Some of the junk bonds have already dropped in value considerably. That's all par for this course. So that's all positive steps. The REITs have to come down a lot. The bank shares have to come down a lot, especially in Canada. Revisiting where the venture and the Canadian dollar are, frankly. The venture and the Canadian dollar, the resource sector, venture exchange, and the Canadian dollar are already back where they were at the last cycle low in 2009. It's only the dividend-paying, REITs and banks, basically, that are holding the TSX up. And once they recouple, as they always do, Jim, always have before, you're going to get a TSX somewhere around the range of 8,000. That's where that suggests that should go. And then we'll see where we're at in terms of whether that's enough to mean revert for the prior excesses or whether you have to have, a period where the assets are on fire sale, not just coming back to fair value, but actually going well below fair value. And that's actually quite typical of at the end of a secular boom phase. In the mean reversion, you typically get asset values going well below fair value. And that's when it's just like, an elixir for the economy and for those that have savings, because the opportunities then are the absolute opposite of today, where there's hardly any decent opportunities. In that environment, there's a million different opportunities, all at great value, and it's a very financially exhilarating time. But first, you have to get there. And I think it's started. I think we could be within, we could be over the next year seeing a lot of value revealed. And, it'll take what it takes. There's no way to know for sure how long it'll take to play out, but I'm pretty encouraged that we're seeing a lot of steps in the right direction right now.
This is sort of like what happened 100 years ago. The horse and buggy overtaken by the car. The blacksmith shop wasn't important anymore, but that will be replaced, I believe, by 3D printing.
Yeah, I think 3D printing is another huge, again, think about taking out friction costs, right? Not only is there a whole bunch of middlemen taken out of those equations when people are doing direct printing of things, but also transportation costs, packaging. A lot of this stuff is just rendered redundant. If you look at the Asian shipping index, now part of that is because there was such a huge, a massive overinvestment in vessels to to ship goods in the consumption boom and the credit bubble. People, invested in all these transport vehicles they thought were going to be shipping this, insatiable amount of goods around the world. Well, they brought out huge supply just at the time that demand peaked and has been crashing ever since. Now we've got redundant transportation items all over the world, just like redundant retail space. I mean, you name it, we got it. But 3D printing is exasperating that, right? Because suddenly people will not have to order things from the other side of the world. They'll be printing them in real time in their own presence. Just try and get your noodle around that, right? So it's, as I say, a lot of these old antiquated business models that were banking on insatiable demand growing and growing and growing are going to be in a big consolidation phase over the next few years.
Danielle, thank you very much for chatting with us.
Hey, thank you, Jim.
My guest has been Danielle Park, editor of the popular blog Juggling Dynamite and president of Venable Park Investment Council Incorporated. You're listening to HowStreet.com radio. Find us on Twitter at Talk Digital Net. Check out our popular YouTube channel, Talk Digital Network. You can forward questions or comments about the show to info@HowStreet.com. I'm Jim Goddard.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.